Hello, everyone. Welcome back. Today, we're going to talk about Fannie Mae Forecast 2024 and 2025. And we're going to talk about the mortgage rates. And my name is Seewing Yee from the Real Estate Network. I'm a real estate wealth advisor for investors. And my co-host, once again, is Richard Advani, who is an investment loan agent serving investors loans on all 50 states. Combined, we have assisted many hundreds of even thousands of real estate investors to buy investment properties in good part of the country and therefore create a lot of wealth. And we are on the ground every single day monitoring the changes in the housing market. I've done for many years, and information we provide, we believe is very credible. It's a very accurate data as opposed to all the misleading information that are out there in the social media and the YouTube video and what have you. We got dive deep. So hopefully you enjoy the content. And Richard Advani, go ahead, share your screen and go over the powerful information so investors can make informed decisions in light of what's going on in the housing market. Thank you so much. So
the theme of today is firstly, why wait to buy real estate, as we always say. You buy real estate and wait. And whether you're looking at an owner-occupied home or an investment property, a lot of what we're going to cover today is very important because there's a lot of people sitting around right now waiting for interest rates to drop to where they were. It's important to note that not only are they not going back to where they were, I don't know about you guys, I've got a 2.5% 30-year fixed on my house. The odds of getting even double of the lows is probably gone in the short term. What I'm about to share here is Fannie Mae's interest rate forecast for the next 2 years. And it's interesting to note they're already off. Rates are quite a bit higher than what they did forecast. So before I actually pull it up here to keep your guys' attention, so one thing to note is interest rates peaked out at the third quarter of last year. The 10-year treasury hit the mid fours. And with that, a primary home 30-year fixed was north of 7%. And what happened in January was inflation data initially came out showing inflation was coming down. And there was a lot of other positive factors that helped push rates down. And rates for a primary home started actually moving towards the mid sixes. Okay. What's happened since then, especially in the last week and a half, is rates have been rallying back upwards. Inflation data came out, inflation and CPI is a little higher than expected. Jobs report came out, the jobs market is robust. And these are good things for the economy, but not good things for the 10-year treasury bond. The 10-year treasury bond typically will do better as inflation comes down and as we get a better handle on the economy. That being said, earlier this year, Fannie Mae came out with their interest rate forecast for the next 2 years, basically through 2025. And what you'll see here and what I have outlined in the box is their projection. So if you look here, we're in 2024. So we'll stick here. And if we look in 2024, this is first quarter, second quarter, third quarter, and fourth quarter. So Fannie Mae estimated that the end of the first quarter of 2024, primary home rates would be around 6.5%. Now, keep in mind, we're nearing the end of the first quarter now, and primary home rates are north of 7%. Let's keep in mind they're 0.5% off right now. If you look at second quarter, they're talking about rates moving to 6.3. By the end of the year, primary home interest rates moving down to 5.9. Now, once again, mind you, they're already 0.5% off. So that 5.9, assuming that 0.5% off carries, the 5.9 is really 6.4. That's the end of 2024. Now move with me into 2025. As you can see, there's a marginal difference in rates that Fannie Mae projected from the end of 2024 through the end of 2025. Not even 0.25% lower, 5.9 to 5.7. So at the end of 2025, for a primary home buyer with good credit, the best case scenario, according to Fannie Mae, is 5.7%. Once again, they're off 0.5% right now. So let's meet in the middle, okay? Let's say 0.25% higher puts the primary home national average rate per Fannie Mae at the end of 2025 at almost 6%. And it's important to note because that is the new reality of where we are today, okay? If you're going to get a 6% or a 5.9%, 30-year fixed, for a primary home, keep in mind, rentals are going to be higher than that. That is the new normal. So if you're sitting, whether it's once again a primary home or a rental, you're waiting for interest rates to drop so you can act, It's not coming, guys. I want it to come. I'm in the mortgage business. I hope I'm wrong, and I hope Fannie Mae's wrong. But from the looks of it, in the next 2 years, 3 years, there isn't this major dip coming. What is going to happen, though, is we experience a drop between the middle and end of this year as the Fed starts lowering rates and we get a handle on inflation. All that pent-up demand, everyone I know that's waiting to buy a house is going to go and buy a house. And I think there is going to be an appreciation jump again leading into the summer and third quarter of this year because all that demand. But and from there, we're going to see some modest and moderate appreciation with this, which is healthy for the market. But once again, to reiterate, unfortunately, rates aren't going sharply lower. And if you're waiting to buy a home, I would base it on 6% and see whether you can afford it. See if you're buying a rental, see whether the numbers work. That is the new 4%. And that is the new reality of interest rates we have to deal with. And if we look historically, right, I don't care 50 years ago that the rates were 17% or 15, 20 years ago, if you look at the curve of the 30-year fix over the last 60, 70 years, we're not at a high point. We got spoiled for a long time, but we're not at a high point. Before we move on to the next segment and next slide, Seewing, anything you want to add on that?
Yes. From what I hear you saying is that right now, according to Mortgage News Daily, people with less than stellar credit, FICO score of 650 to 700 FICO score, for example, primary home owners, they might have to pay 8%. 8% today's March 2020 to get a home loan for primary buyers. Now, for investors, like you alluded to, Richard, investment loan rates are slightly higher than a primary home loan rate. Investor today, without any kind of buyer's rate buy down, if you were to buy an investment home and finance it, or without any points paid out as well, you could be paying 7.2, 7.3% or investment loan, 30-year fixed rate mortgage. Now, as I hear, Richard, what you're saying is for the next 2 years, according to the Fannie Mae slightly off rate forecast we just went over, the next 2 years are not going to be any better than today. So 24 months of waiting for investment loan rate to be, you're going to be getting like 6.5 to 7% for investment loan rate throughout the 2024 and 2025. So the cost of waiting amid the systematic appreciation that we expect because of the historic low supply of inventory and still pent-up demand, for those who are going to wait, you're going to forego potential 5 to 7% appreciation in certain markets. You're going to be waiting. You're going to lose out on cash flow. If you buy today, you lose out on cash flow, on tax benefit, on loan buy down by your tenant. So you're losing multiple layers of profit by potentially not pulling trigger, by sitting on the sideline for the next 24 months. And at least interest rates not going to change at all. And we're seeing bidding wars, even at this current market condition, in many areas of the country, 10 offers per house, 20 offers, 30 offers, from what I'm hearing from the people on the ground that I know, similar with you, Richard. So go ahead. What you got to show on your next slide?
This next slide is really important, especially in this market and especially in what we just covered. And what I have here, firstly, is an example of a $300,000 investment purchase with 25% down. And there's only one assumption I've taken here. The rest of it is math. We all believe in math. So the assumption I took here is a national average appreciation rate of 3% per year. Now, it's important to note from 1968 to 2009, prior to the last 15-year crazy rally we've experienced, the national appreciation rate was 5.7%. We factor in the last 15 years, it's obviously much higher than that. I think we can all agree with inflation being at 2% too, that a 3% average appreciation rate applied in this scenario is very conservative. It's half of what it's been for the last 40 or 50 years. Now, a lot of performers you're going to see out there will have 6% and 7% and 8%. I'm not saying those are wrong. However, it is important to note that I base this example off of, once again, 3%. So what I've looked at here is the equity gain by year 5 based on that 3% per year appreciation rate, which once again we covered is very conservative. And on top of that, I've also looked at the principal pay down over the course of the first 5 years, the return on amortization. Now, as you can see here, what's crazy is Year one, at 3% appreciation on this $300,000 property, you're at $9,000. Year two, year three, year four, year five. So at year five, based on that conservative 3% appreciation per year, you've gained $37,652 in appreciation, which is 52% of the down payment amount. And I know there's closing costs. We're talking broad level here. So you made 52% of your down payment amount back in wealth building and appreciation by year five. And what's important also is we all know with the 30-year fixed, beautiful that we have access to a 30-year fixed, but they're very heavy on interest in the front. Even taking that into account, year one, you're paying down 3% of your down payment or $2,285 in principal pay down. By year five, cumulatively, you paid down 18% of the principal, 18% of your down payment in principal balance repayments. What's important to look, if you look at year five here, once again, equity gain, with 3% appreciation per year, you've made back 52% of your original investment. And with return on amortization and principal pay down, you've made back 18% of your investment for a total of 70% of your investment has been made back between a nominal appreciation rate and return on amortization just in year five. What do you think happens by year 10, year 15, year 20, year 30? And the reason why this is a powerful example, I'm not saying buy properties with no cash flow or negative cash flow. It's a great way to evaluate property to property. But even if you bought a property today and you made your 6% or 7% cash on cash, it amounts to a couple $100. That's not why we're doing this. That's not going to change our life. But what is going to is buying and holding real estate in the long term, as we can see in this example here. The great news is from this example, this property actually did make a cash flow on the front end as well. But that's not the focus of today. The focus is the long-term wealth building effects of real estate. And when you look at this, sure, you may be able to make more in your stocks in a short period of time, but most people aren't looking at this. They're not looking at the broad wealth building aspects of real estate and the tax-free aspects. And the cool thing is, for example, this return on amortization and the equity gain at 3% per year. That's 3% of the prior year amount. As time goes on, these numbers exponentially start getting better quicker too, because that principal pay down, once again, on the return on amortization increases more and more over time. You're paying down more and more principal. And the equity gain is appreciating 3% of the prior year's value. When you look at all of that, the compounding effect of real estate is huge. It's huge. And the wealth building effect. And I'll tell you personally, properties I bought new construction 8 or 9 years ago that were making 7% cash on cash. It was $180 a month. Didn't change my life. But what's happened today, 8 years later, rents went from $1,395 to $1,895. My cash flow went from $200 a month to $700 a month. This is just in 8 years. So $700 a month times 10 properties is $7,000 a month. Now we're talking real money. And as you can see in this example here, I'm at year 8. I made back 100% of my down payment, not even just in appreciation and obviously return on amortization. I did even better because that $180,000 property is worth $280 or $300 today. So I have more than made my down payment back and my return on amortization. That's setting aside cash flow still. Once I factor in, now I'm making $600-$700 a month in cash flow. The year 10 outlook on the properties are just amazing because you made back 130% of your down payment in just appreciation. You've made back close to 60% of your down payment in principal pay down. And now you're making all this cash flow every month, a 20% cash on cash return with where my mortgages versus the current market rents. Anyway, I thought it was very important to share this after sharing the fact that, hey, rates are not going anywhere. There's not this massive drop coming. However, don't fret because as I showed with this example, the wealth building power of real estate is still very well alive. We got spoiled for a long time, but real estate in my mind still is the path to build wealth. And you know what's, once again, what's beautiful about this example here, it's math. 3% appreciation is the only assumption I made. And once again, that's half of what has been the last 50 years. This is a real world example of what you can expect when you invest in real estate. If you have realistic expectations, hey, this isn't going to make me rich overnight. but it is going to make me wealthy in the long term. And the longer I have it, I'm sure you guys will all agree, now's a great time to buy. And you're married to the property, you're dating the rate. Hopefully I'm wrong, and hopefully Fannie Mae's wrong. And hopefully 2 years from now, we can all get 4.5% 30-year fix. It'll be great. I'll make a lot of money. I'll be really busy, obviously, doing all of that. But I don't see that as being realistic right now, unfortunately. Get off your butts if you're waiting. Now's as good a time as any. Buy smart, do your diligence. But real estate's as attractive, at least to me, as it was even 5 years ago.
Richard, you recap, just you and I have done a lot of videos. I have done a lot of videos with other co-hosts on a consistent weekly basis. I keep on harping just to your point, rental property is the world's greatest multi-dimensional asset class, better than any other asset classes out there, because there are 5 ways you can make money. You just went over that. You can increase your rent, increasing cash flow. Your tenant going to pay down your loan. Your tenant going to pay it off on your taxes, insurance, property management fee, vacancies, maintenance. At the end of the month, you still have positive cash flow. So you just, in the long-term building effect, like you said, see, a lot of people, the problem is they are very fearful. There's a lot of people are confused about the housing market. They look at the very misleading doom and gloom, crash bros videos, crash porn, real estate YouTube videos out there. It just paralyzed a lot of people. So you got to be smart about it. If you want instant gratification, you're not a real estate investor. You're a speculator. If you want to create generational wealth, you got to buy and hold for a long time. The first few years, you might be frustrated. The returns are low compared to your expectation, but you got to stick it out. You got to show the commitment to stay the course. Don't give up. Don't be negative. So it requires a tremendous amount of mindset to overcome all the current volatility and there's so much doom and gloom, negative information. You just have to figure out a way to overcome these kind of things, invest for long term and just hang in there, have proper cash reserve, buy in the right markets, buy in the cash flow markets, mainly in the Midwest and South and Southeast, finding some good turnkey providers. But we have builders that are helping you with the rate buy down. You can get a 5.3% 30-year fixed rate mortgage, and yet the builder is helping you with the rate so you can get much better cash flow right now. And we have properties in Alabama where the seller is paying down your mortgage to 5.5%, 30-year fixed, and nothing out of your pocket, which you're involved in our Florida markets. And you're getting like 4.75% fixed rate. You're getting a 5.4% fixed rate 30-year mortgage. There are so much incentives going on right now. But for those who are going to wait with the pent-up demand, if the mortgage rate can come down even just a little bit from 7% to 6.7, 6.5% in the next few months, all hell is going to break loose. We are already seeing some bidding war. So right now there's very little competition. You can make some good deals, but if you wait too long, you're going to compete against other people coming off the sidelines and the prices are going to go up. Just cost of waiting, which you know, I've been talking about it for the last several years. You lose money by staying on the sideline and thinking you can get a better deal 2 or 4 or 5 years later. Some of you may be waiting for forever before you think you can get a deal by waiting. It's just bad decision by not doing anything right now. But that is my recap. Anything else, Richard, you have to say to recap what you discussed? Our information?
No, I think that was a good recap. And hopefully this is a wake-up call to a lot of people. And this isn't doom and gloom. This is just reality of where it is. This is the opposite. This is doom and gloom. It sucks rates are where they are, but that's the nature of where we are. The wealth building aspect and benefit of real estate still shines loud, bright, and clear. And there's a lot of investors and primary home buyers that are jumping back into the market quickly because they know what is coming.
Right, Richard, again, you and I have a lot of practical information. We help thousands of investors achieve a generational wealth for many years. We have boots on the ground. We know what market works. We know what turnkey provider to work with, especially for California investors. Buy where the numbers make sense. Powerful information. This is real information. This is not BS stuff. This is real stuff from the people that in the know, you and I and our people we work with. Rich, thank you so much for your very enlightening information. You're not going to get the information from too many other sources out there, too many credible sources out there that we provide. So thank you so much, Richard Advani from Guarantee Rate Mortgage. Thanks for watching, everyone. This is Seewing Yee. I'll see you on the next video coming up shortly. Thank you so much. Have a nice day. Bye-bye.